Hello, I'm Sam Pearl, and this is The Art of Dealmaking. Today my guest is Glen Anderson, CEO and co-founder of RainMaker Securities. Glen, thanks for coming today.
Happy to be here.
Glen, I was hoping we could start off with a little bit about your professional history and what you do at RainMaker.
Absolutely. So RainMaker Securities is a merchant banking platform. It's based in Chicago. We have offices in Los Angeles and Oakland, California. And we were founded with a vision to help primary issuers of equity and debt, private issuers of equity and debt, raise capital, find exits, and employees of those companies also to find exits. We focus primarily on technology companies or companies in where technology is an important part of their business. That's where I come from. I started my career at IBM and Motorola, and was a technologist throughout the 90s before moving into finance. And in my career in finance, I covered technology companies as an investment banker and as an equity analyst.
What are typical reasons for someone to sell their secondary shares?
So, just to be clear about what secondary markets are, there's the primary market, which is a company issuing equity or debt. So a direct sale of equity or debt from the company. Secondary markets are when early investors or employees, or current employees or ex-employees, already hold the shares and would like to find an exit. And it's become it's a market that's been growing very quickly. A big catalyst for that growth was Facebook prior to its IPO. A very active market developed in the sale of their shares, early employees looking for exits and such. So the typical reasons why sellers sell in secondary markets is there's tax reasons. Maybe they have options that vested, and so they need money to pay their tax bill essentially. And personal reasons. The vast majority of the time we are never approached by an investor, early investor or employee to sell their entire position. Usually it's a portfolio diversification strategy. Keep in mind when you're talking about these late stage pre-IPO companies like Facebook and Twitter before they had their IPOs, today like Square, Palantir, or Pinterest, or Spotify, or these sort of late stage companies that are probably within 12 to 18 months of their IPO. Many of the employees started their career, they came out of college as an engineer, started with the company, and on paper they may be worth, in some cases, millions of dollars, but it's not liquid. So essentially these are 20-something-year-olds, still living in a one-bedroom apartment, still paying their student loans, still driving a Toyota Camry, but they're sitting on millions of dollars worth of paper wealth. And in some cases, they just want to improve their lifestyle and benefit from that paper wealth.
How does RainMaker find buyers for these secondary securities?
The secondary markets is an interesting market because with the primary markets, typically a company comes to you, they're looking to sell their equity or debt, and you develop a distribution strategy where you identify investors and approach investors. In the secondary markets, often buyers are coming to us. There's a lot of interest in these late-stage pre-IPO stories, and the challenge in this market, in the secondary market, by contrast to the primary market, is not finding buyers. There's a lot of buyers with interest in these stories. It's actually finding sellers, finding early investors or employees that hold the shares and are willing to sell those shares. So often buyers are approaching us to see if we can source shares in these companies.
Does RainMaker sell positions in funds?
We do. Often with these shares, they're held by an investment fund that bought the shares early, or often the shares are aggregated into what's called special purpose vehicles, where a group of sellers aggregate their shares as an investment club, or a broker aggregated a set of shares into one of these special purpose vehicles. So often when you're doing a secondary transaction, you're selling part of one of these funds or part of one of these special purpose vehicles to investors. So they're not holding the shares directly, they're holding them indirectly through these funds.
Tell me a little bit more about the market. Are there restrictions on who can buy or sell secondaries? Is the market growing?
There are definitely transfer restrictions. In many cases, companies, the sorts of companies that investors are most interested in, many of these companies are nearing a time where they probably will do an IPO in 12 to 18 months. And as such, they're very conscious of their cap table. And they want to make sure that the investors on that cap table are the kind of investors they want on their cap table. Additionally, they don't want the cap table to be too fragmented. So often there are transfer restrictions. In some cases, there's an outright ban on sales by employees of their shares. The way you get around these sorts of transfer restrictions is often we can structure a transaction, structure a sale transaction by a seller through what's called a forward sale contract, which is which is essentially equivalent to a futures contract. It's simply the asset that's getting delivered is the shares at a future date once the transfer restrictions are limited. Another way to execute a transaction when the shares are under restriction is to use the shares as collateral in a debt transaction. So the investor would put a note in place with the seller under the note, and the collateral against the note is the shares held by the employee. So in both cases, the shares are actually not changing hands in terms of ownership as far as the company is concerned. In fact, the company typically doesn't even know these transactions are occurring, but because there is a separate transaction between two private parties, and there's the forward contract or the debt contract in place, in effect, the investor then has a claim on the shares. So it's a way to transact without officially transacting, if you follow me. With respect to the growth of the market, there's absolutely growth in this market. When the Wilshire 5000 Index was founded, there were 5,000 public companies that the Wilshire 5000 Index covered. Today, there's 3,700 companies in the Wilshire 5000 Index. In other words, many companies are choosing either not to become public, to do a go private and return to a private company. Consolidation in industries has reduced the number of public issuers. Essentially, more money is raised in private transactions nowadays than public transactions such as IPOs. And so there is a very large market in private securities, and it's growing very quickly. And the appetite for liquidity by sellers is really has always been there, but now there's more mechanisms by which they can find that liquidity. And on the buy side, there are a lot more funds that specialize in investing in private securities, such as late-stage pre-IPO companies. Additionally, there's a lot of capital overhang by investment funds that need to put money to work and see that the opportunity right now is in the private markets and not in the public markets.
To finish things off, what advice would you give investors who are looking to diversify their portfolios with secondary shares?
I would say, private securities are, you have to look at the risk-reward relationship in any investment. Private securities are, by their nature, typically earlier stage than public companies, and you have to evaluate that risk when you're making an investment. However, private securities also historically generate higher returns than the public markets. The numbers as an average over the private equity asset class over the past 30 years has been about a 27% internal rate of return, compared to 8-9% for the S&P 500. So you can get a lot of alpha by investing in private securities, but you also have to recognize that there's much higher risk in investing in these companies that are earlier in their growth cycle. So I would say my recommendation to investors is take a hard look at investing in private securities. It can be a very powerful alpha in your portfolio, as long as you recognize that it is higher risk, and so you need to balance that when you're looking at your entire portfolio in terms of diversification.
Glen, thanks for your time.
Absolutely.
Again, this was Glen Anderson, CEO and co-founder of RainMaker Securities. And as always, here's to the deal.